Creating an investment portfolio can seem daunting, but it doesn't have to be. The key is to diversify your investments across different asset classes and industries. This way, you can spread out your risk and potentially increase your returns. A common approach is to include a mix of stocks, bonds, and cash in your portfolio. Stocks represent ownership in a company and have the potential for higher returns, but also carry more risk. Bonds are a type of debt investment where you lend money to a company or government in exchange for regular interest payments. They generally have lower returns than stocks, but also carry less risk. Cash, such as savings accounts or money market funds, provide a lower return but are considered the safest option. When creating your portfolio, it's important to consider your investment goals, risk tolerance, and time horizon. For example, if you're saving for retirement and have a long time horizon, you may be able to tolerate more risk in your portfolio. However, if you're saving for a short-term goal, such as a down payment on a house, you may want to focus on more conservative investments. It's also important to regularly review and rebalance your portfolio to ensure that it continues to align with your goals and risk tolerance. This may involve selling some of your investments and buying others to make sure that you're still diversified and that your portfolio is still in line with your investment strategy. It's also a good idea to consult with a financial advisor or professional for tailored advice on creating an investment portfolio. They can help you understand the different investment options available and help you create a portfolio that's right for you. In summary, creating an investment portfolio is a way to spread risk and increase returns. It's important to consider your investment goals, risk tolerance, and time horizon, and to regularly review and rebalance your portfolio. Consult with a financial advisor to tailor advice for your specific situation.